On Wednesday, the 14th of June 2023, the Federal Reserve kept its key interest rate steady at about 5%, holding off what would have been an 11th consecutive interest rate increase. The reason? Inflation appears to be finally easing. But in a surprisingly hawkish signal, the Fed's representatives revealed that another 2/4 percentage point moves are on the way, contrasting analysts' expectations that the policymakers would signal just one more rate increase this year. So what's the deal with federal interest rates? In this video, we'll go deeper into federal interest rates so you can better understand what such changes mean to us. You'll learn exactly what interest rates are, their role in the economy, and their impact on borrowing and lending. And how do they affect the stock market and investments? What about their effect on your personal savings and retirement? Well, watch to the end to find out. Let's get started. First of all, what are federal interest rates? Well, federal interest rates are the interest rates set by the central bank for short-term borrowing and lending between various financial institutions. Here in the US, the Federal Reserve, currently under Chair Jerome Powell, controls the federal interest rates. To influence interest rates, the Federal Reserve uses the federal funds rate, which is essentially the interest rate at which depository institutions like banks lend reserve balances to other depository institutions overnight or for a few days. Just to add, the federal funds rate is the benchmark for other short-term interest rates in the economy. And who determines the federal funds rate, you might ask? Well, the Federal Open Market Committee, FOMC, which is the monetary policy-making body within the Federal Reserve, sets the federal funds rate. This committee regularly assesses economic conditions and adjusts the federal funds rate to achieve its dual mandate of promoting maximum employment and stable prices by controlling inflation. So going back to what I said earlier, FOMC is the force behind the decision to keep interest rates steady at 5% in June 2023 and the possible upcoming 2/4 percentage point moves. Now that you know what federal interest rates are, let's see how they impact the economy. So, federal interest rates significantly impact the economy by affecting borrowing and lending. This occurs because federal interest rates directly impact mortgage rates, credit card debt, loans, and credit availability. Let me tell you more. When the Federal Reserve raises interest rates, mortgage rates increase, making homeownership more expensive and potentially slowing down the housing market. As for credit cards, their interest rates are often tied to federal interest rates too. Higher rates lead to higher APRs on credit card balances and increased financial strain for individuals. Regarding loans, rising federal interest rates can result in higher interest rates on various types of loans, making borrowing more expensive for individuals and businesses and potentially reducing loan affordability. Lastly, federal interest rates affect the availability of credit in the economy, in that lower interest rates encourage borrowing and make credit more accessible. Up next, let's talk about how federal interest rates affect the stock market and investments. Here's the thing. Federal interest rates significantly influence the stock market and investments by shaping stock prices, sectors sensitive to interest rates, and bond markets. Let's quickly break it down. Stock prices. Changes in interest rates can influence stock prices, with low rates potentially leading to higher stock prices due to reduced borrowing costs and increased investor confidence. Sectors sensitive to interest rates. Sectors like banking, real estate, and utilities are susceptible to interest rate fluctuations, as higher rates can affect their profitability and borrowing costs. Bond markets. Federal interest rates also directly affect bond markets, with rising rates making newly issued bonds more attractive and potentially decreasing the value of existing bonds. In contrast, lower rates can boost the value of existing bonds. Moving ahead, let's see how federal interest rates affect your personal savings and retirement. When it comes to your personal savings and retirement plans, changes in interest rates directly affect savings accounts, certificates of deposits, CDs, and retirement funds. Higher federal interest rates lead to increased interest rates on savings accounts, allowing individuals to earn higher interest income. Conversely, lower federal interest rates result in reduced interest rates on savings accounts, lowering the amount of interest earned. As for CDs, rising interest rates increase the rates on new CDs, making them more appealing for savers, while falling interest rates may decrease the rates on new CDs, potentially reducing returns on these investments. Last but not least, federal interest rates also affect retirement funds comprising investments such as stocks, bonds, and cash equivalents. For instance, rising interest rates can cause bond prices to decline, impacting the value of bond holdings and retirement funds. Conversely, falling interest rates can boost bond prices, benefiting bond holdings. Now, what do you think about today's topic? Let me know in the comment section below. While at it, like, subscribe, and turn on notifications to get alerts for upcoming videos on macroeconomics and its impact on individuals.